All right, we talked about the different manufacturing costs that I will incur as a result of wanting to produce the product I sell rather than just buying it from a wholesaler already to sell. And and so now, what are the implications for the financial reporting and for the accounting function if I choose to do that? We talked about the three manufacturing costs, and another term for manufacturing costs is product costs. What are the costs that I'm going to have to incur to produce this product? I'm going to have to buy materials. I'm going to have to hire labor to convert those materials into the product that I want to sell. And then I'm going to have to incur a lot of different costs just to create the environment in which the workers can convert these materials. And these factory overhead are all other costs of the factory, including the rent, the depreciation, the indirect materials, the indirect labor, the repairs, the supplies, the paper towels, the window cleaning of the factory. Every other cost of the factory is going to be incurred for that. So what we want to know is, what are the implications now going down with regard to the balance sheet? How are things going to change in the accounting function? Okay, well, let's see exactly what that change would be. Okay, let's start with, let's just go with my donut store. I currently do not produce donuts. I'm not a manufacturer. I'm just a merchandiser. So I buy donuts already made. They get delivered every day, and then I sell them in my store. So the accounts that I have on my general ledger as a merchandiser is really just this. I have an inventory account, asset. It's mine until I sell it, debit balance. I have sales. When I sell it, I record the sale, my revenue from those, as well as I transfer the cost out of inventory to cost of goods sold. So that is when a sale is made, I record the sale amount, and then I record the cost, transfer it out of inventory over to cost of goods sold. And then I have a lot of period costs that are associated not with producing a product, because I'm not producing it, and it's not associated with the cost of the product, but it's associated with running my store. I have salary expense, got somebody behind the register there. I rent my store. I have insurance on my store. I have supplies, cleaning supplies. Perhaps I'm depreciating the cash register and the display counters. I do some advertising. I have repairs to the store periodically. Legal expense. Maybe I just have some legal expense. Utilities. Got to light the place. Tax expense. Maybe payroll taxes, city tax licenses, things like that. So as I incur costs, I buy products. Well, when I buy the donuts, when they're in my display case, they're not a cost yet. They are part of my inventory. But then when I sell them, they become a cost. And then as I pay for these other expenses of operating my store, these are the period costs. So for a merchandiser, all I have is one inventory account, because when I get the inventory, boom, it's ready to sell. But now if I decide that I want to manufacture them myself, keep in mind I've got a store here. It's a pretty store, it's got beautiful windows, and that's what I sell it out of. But now I decide I want to manufacture it myself. I know that I can make money, because the guy I'm buying it from is making profit from me. Maybe if I make them myself, I get to keep it all. So I'm going to open a factory. And like I said, it may be in the back room, it may be across the street, whatever. But how's that going to change things? Well, it's going to do this. No longer am I going to have just one inventory account. I'm actually going to be tracking 3 different phases of inventory. The first one is going to be raw. Drop this down a little bit so you can see it better. Focus on this isn't the greatest, but first one is raw materials. The second phase of inventory is work in process. And the third one is going to be called, and we're going to call it finished goods. Finished goods. Now these are three different levels of inventory. They are inventory, but this is what's taking place in the factory. Now, what are these three different levels of inventory? Well, the first one, raw materials. Raw materials. Raw materials is is when I purchase materials that have not been used in production yet. Not been used. This is for a donut store, for a donut manufacturer, this would be everything that's in the refrigerator and everything that's in the cupboard and everything that's in the pantry. It's flour, shortening, sugar, salt, cinnamon, everything, food coloring that has not been used in production yet. It's currently just on the shelf being waiting to be used. For a furniture manufacturer, it could be wood, nails, staples, glue, just sitting waiting to be used. Raw materials, you can envision it as a very quiet room that just has materials in it, it's just waiting to be used in production. It has not been placed in anywhere. It's sitting quietly. So that's the first level of inventory, just buying inventory, purchasing it, and coming in, sitting in raw materials. So this is when we purchase raw materials. The second level of inventory is work in process. That's where the production facility is. Think of work in process as the assembly line. It's where the actual production process is taking place. It's the half made or 3/4 made or 1/10 made. It's products that are currently in production. This is where the activity is. This is where all the direct labor is being done. This is where the conversion process is taking place. And this is a different level of inventory. Now, in producing a product, many times the company will determine what do they need in raw materials, and they'll purchase those materials and they'll be put in the raw materials. Then they will go get those raw materials. They will take it out of raw materials and take it out to the production floor. So this is where I use the raw materials. So this is the direct materials. That's the first cost of any product. What did you go get as far as materials? Brought it out on the production floor. Boom, it's all sitting there, all unassembled, untouched. But that's the first cost of any product, is the materials that go into it. Then, as it's being worked through over a period of time, we're going to incur direct labor. So direct labor is going to be added to it as well, because that's really kind of the second cost of producing a product, is the labor, the people that I have to pay to convert the materials. And then third, I'm going to have factory overhead costs. I gotta heat that place. I gotta light that place. I gotta provide safety measures. I gotta insure that place. All the indirect costs of the factory during that period of time. These are all going to total up to a certain amount of money. When that product is all done, we're going to know, well, what did it cost to make that product? Well, it took this much in materials, this much labor, and this much indirect environmental overhead costs to provide a setting in which to do that. And when it's all said and done, then the total cost of that is going to be transferred to finished goods. That's the total cost to produce it. This is called, and I'm going to use an acronym, cost of goods manufactured, not cost of goods sold, but this is the cost of goods manufactured. This is what it cost me to make that thing. And now what's in finished goods, it's beautiful and it's all ready to sell. It's been packaged and it's sitting on the shelf ready to sell. Now this is equivalent to the inventory account that we just saw in 4A. It's just that I bought it just like that. It just came from an outside party. I just bought it and it came in here. But if I'm manufacturing it, I've got 2 levels of inventory before that. The materials I bought and then used, went and got some of them, hired some people to convert it, incurred indirect factory overhead costs to get a total cost of that product, and that's where it'll sit until I sell it. It may sit there for years, but then when I sell it, then it gets transferred to cost of goods sold. Now, how does that change these costs over here? It does not. The person that's working in the factory here, or in the factory, the people that are working in selling, they're still period costs, selling expenses. The rent of this place, still rent expense. January's rent in January, February's rent in February. To insure the store, we expense it as incurred. Supplies used, doesn't matter how many units I sell. We incur these in the period in which they are incurred. The utilities for May are expensed in May. No change here. There's no change whatsoever. As a matter of fact, there's really no change here. The only thing that changes is where's the cost of my inventory coming from? Is it coming from an outside party, or am I producing it, tracking it all myself up to this point? To this point, it's all the same. Let's go back to this and let's look more specifically at this right here, this factory overhead. What's this factory overhead made of? Well, it's all the indirect costs of the factory, which includes, for one thing, rent. When I pay the rent, the January rent on this factory, how will it be expensed and when will it be expensed? When I pay that rent, is that rent expense? The answer is no. The rent on the factory gets charged. We're going to track that as a cost of everything that was produced that period. During the month of May, that rent is going to be allocated, and we'll talk about that in the next chapter. That's going to be charged to all the products that were produced that period of time. And that rent becomes a part of the cost of the products produced, which is sitting in finished goods. The finished goods includes a portion of the rent that was incurred while I was producing it. And then when I sell it, that cost is going to come down to cost of goods sold. So how will the rent on the factory be expensed? It's going to be expensed as cost of goods sold. It was part of the cost of goods manufactured, and therefore will be cost of goods sold. And this is what we really need to nail down. The rent on the factory will not be rent expense. It's going to go through this process and ultimately be expensed as cost of goods sold. If I produce a product in January and it goes into finished goods, ready to sell in January, and it doesn't sell until June, when will I actually expense this rent? Because rent is a cost. When will it be expensed? In January when I produced it, or in June when I sell it? It's not going to be expensed in January. In January, it's going to become part of the cost of the product that was produced in January, and it's part of the cost of the product sitting on the shelf. When I sell it in June, that's when it'll be expensed as part of cost of goods sold. How about the security guard salary, indirect labor, security guard salary? Is his expense going to be expensed as part of salary expense? No. The security guard here is an indirect expense, indirect labor, which is part of factory overhead. It gets added to the products that were produced during that period of time. It's an inventoriable cost, becomes part of the cost of the product and sits in finished goods until we sell it. That might take years that it'll sit here, but when it's ultimately sold, it goes down to cost of goods sold. What does the cost of goods sold actually include? It includes the materials, the labor, and a portion of the factory overhead incurred while that was being produced. None of these expenses incurred in the factory will ever end up over here. Every one of them will end up in cost of goods sold because these are all product costs. They're all product costs. Every expense of the factory funnels into cost of goods sold. Okay. Now, going back to the chapter, we've got the costs and how do they affect the balance sheet? Well, we have three different inventories. Raw materials inventory, which is defined as goods that a company acquires to use but haven't used yet in producing a product. It's very quiet room, just with things on the shelf ready to be used. There's work in process. It's the costs of goods that are in process but not completed yet. Here's a picture of the work in process, and there's a direct labor. His salary, he's obviously working on this, whatever this thing is. What he's costing me is a cost of this product. He's a direct labor. Then there's finished goods. Finished goods is the account that controls the finished goods files. What does that mean? Well, it's just that they're the costs of goods that are ready for sale, and they're just sitting there ready to be sold. So a balance sheet for a manufacturer, well, let's start with this one. For a retailer, just has merchandise inventory. For assets, got cash, accounts receivable, inventory. But for a manufacturer, we've got three levels of inventory. Raw materials, inventory of materials that haven't been used, cost of inventory that's in process, still got a ways to go, and then finally, what's sitting on the shelf ready to sell. This finished goods inventory is equivalent to merchandise inventory. We just break it down because there's so much more involved in it now. How about the income statement? Well, the income statement is this confuses me. I don't know that maybe we'll come back to that, but that really kind of confuses me. How does the income statement look for a merchandiser as opposed to a manufacturer? Okay, well, I think what I'm going to do is give you an example of this, and then we'll go back and look at it. Okay, now for a merchandiser, going back to 4A, very simple, not producing our product. We have merchandise inventory that I purchased from an outside producer. And I'm going to say that my beginning inventory at the beginning of, we'll say January, was $10,000, just to put some numbers to it. Now, I actually purchased during the period of time, I purchased $200,000 more inventory, but I sold a lot of this. I actually sold most of it. And so I'm going to say that I sold what cost me, I'm not sure what I sold. I know that my sales were $370,000. But what did they cost? Well, let's go take ending inventory. Let's go take inventory at the end. And inventory at the end was $15,000. So I wonder how much is actually gone. Yeah, I obviously sold a lot, $370,000, but what did it cost? Okay, well, we can do this. Remember what the format is, and this is going to be important, that beginning inventory plus what I purchased equals the total available to sell minus ending inventory minus what's left gives you the cost of goods sold. So if we put numbers to this, I started with $10,000 of inventory. I purchased $200,000. So there was available to sell $210,000. What cost me $210,000? Did I sell it all? No. How much is left? I went and I took inventory. There's $15,000 left. So what was the cost of what I sold? Oh, $195,000. That's what I want to take and transfer to cost of goods sold. What I sold for $370,000 cost me $195,000. The net of these two is called gross profit. So my gross profit was $175,000. What I sold for $370,000 cost me $195. How do I know it cost me $195? Because I started with 10,000, I added 200, so that's 210. I still have 15, so 195's gone. 175,000. Now that's just my gross profit. Then I'd have to subtract off all these period expenses that I had. Remember, salary expense, insurance expense, all the period costs, the costs of the selling and administrative expenses, costs of selling the product and office expenses. So that's how it would look in a retail, or in a merchandising environment. Merchandising as assumed or as opposed to a manufacturing. So the income statement would look much like this. Sales would be a certain amount, and then I want to match up with that. What did those sales cost me? What was the cost of those sales? Well, I have to figure it out. From beginning inventory, whoops, I want to do this one. Sales, and then what was the cost of those sales? Well, what was my merchandise inventory? Remember, that's the only inventory account that I have as a merchandiser. Merchandise inventory, beginning inventory, December 31st of 16 is the beginning of 17. What I ended with in 16, beginning inventory plus the cost of merchandise I purchased gives total cost available, minus ending inventory is the cost of what's gone. That's exactly what I have here. Beginning plus what you bought is what's available, minus ending inventory gives you cost of goods sold. Gives you your gross profit. And then you subtract off all these period costs to get to net income. So that's what we're doing. Just showing them how I computed the cost of what's gone by analyzing the finished goods inventory. But how's that going to change on the income statement for a manufacturer? Not very much. Let me show you how that's going to change. If I decided that I didn't want to buy from an outside party, but I wanted to produce it myself, from a balance sheet point of view, I'm now going to have a raw materials inventory, a work in process inventory, and we're not going to call this merchandise inventory, we're going to call it finished goods inventory. Finished goods. Okay, now, finished goods, same thing. I have a beginning inventory. But I'm now no longer purchasing it. This is cost of goods manufactured coming out of work in process. Yeah, it's not cost of goods purchased because I didn't purchase it. I manufactured it. Cost of goods manufactured. So what I started with, plus the cost of everything I manufactured, minus what I still have is the cost of what I sold. Everything else is the same. Everything else is the same. We just need to change two titles. Not merchandise inventory, finished goods inventory, not purchases, cost of goods manufactured. So how's the income statement going to be different then? Not much. This is the merchandiser. Let's go see what a manufacturer's looks like. Sales, well, that's what you sold it for. And your not merchandise inventory beginning, but finished goods inventory beginning, plus what I manufactured gives me cost of goods available, less finished goods inventory gives you the cost of goods sold. Compare that to what you sold it for. That's your gross profit. And then you subtract off all the selling expenses, the very same selling expenses. Yeah, this being a manufacturer or a merchandiser does not affect. These are going to get expensed in the period in which they're incurred always. It's just if I'm going to add more costs over here to produce it, all those costs have to funnel through these accounts and end up in cost of goods sold. So the presentation on the income statement is nearly identical. We're just not talking about merchandise inventory. We're talking about finished goods inventory. And I'm not purchasing goods to add to it. I'm manufacturing goods to add to it. Really, that's the only difference. So the balance sheet changes in that we have three inventory accounts, three different phases or levels of inventory rather than one. And these costs are just flowing through this in the same way. We just call them something a little differently because I'm no longer purchasing, I'm manufacturing. These same concepts can be provided or can be applied to a service provider. And when you're selling a service, you don't have a cost of goods sold. You're selling a service, so there is no inventory. So, yeah, let's see here. I guess we could take a look at this real quick. What are some of these terms? How do they apply to both to a manufacturer or a merchandiser? Here's the guy making it. Here's the guy just buying it. Here's the guy that doesn't have inventory at all. Merchandise inventory, that's just a merchandiser. Yeah. Service providers don't have inventory. Finished goods, well, that's one of the three inventories of a manufacturer. Cost of goods sold. Both a manufacturer and a merchandiser have cost of goods sold. Service providers don't. Selling expenses, they all have them. Operating expenses, they all have them. Cost of goods manufactured, only the manufacturer has that. Supplies, they all have supplies. Raw materials inventory, that's one of the three inventories of a manufacturer. You might need to spend some time with this. Of course, you'll have to spend some time with it just to get familiar with it, but it's not rocket science and it's not a foreign language. It actually works out. It'll work out well. This is a rather short video. The next video, and I think what will be the last explanation video, will be something called the cost of goods manufactured. And just to give you an idea of where we're going with this is in this case where we have this cost of goods manufactured. Whoop, no, not that one. This one right here. Let me put this back down. Hold on. For a merchandiser, someone who does not manufacture it themselves and they just buy it, and where this is purchases, this is merchandise inventory, and this is just purchases, that's not a difficult number to come up with. It's what you bought. You can look at all for the year or the month or whatever period of time you're doing your financial statements over. What did you buy? What did the gasoline cost that you put in your tanks at Johnny Quick? Or what did you pay the Budweiser company for beers or to Pepsi and Coke for the sodas? What you bought items for is it's a fairly easy number to come up with. But if we're producing it ourselves and what we're adding to the finished goods inventory isn't just what I'm buying, but it's the cost of what I'm manufacturing, that becomes, I mean, you're going to have to hire a team of accountants to help you track that number, because now you've got to track raw materials, which is you've got to track the cost of the direct materials going into products, as well as the direct labor going into products, as well as a portion of the factory overhead going into every single product produced. Somebody's got to track all of those costs. And because that's such a large and a big job, this number is really what gets is what's kind of tough to track, because it's all flowing through the work in process and flowing into finished goods. So this deserves its own financial or supporting statement. Yeah, we need to show that on the income statement for a manufacturer, when we say sales is a certain amount and then finished goods started with a certain number, and then cost of goods manufactured, what I manufactured this period of time amounted to this. There is so much effort that goes into tracking what it costs to produce products that we need a supporting statement called a schedule of goods manufactured. I think that's what it's called. Something like that. Let me see. It's called a schedule of cost of goods manufactured. And that's what the third video that I'm going to post later is going to be, is how do we produce a statement that shows how I came up with this number that encompasses all this activity, boiling it down to this one number. So that's what will be in the third video. So hang in there. You've now made it through 2 videos. Hopefully it's becoming, I know it's probably still cloudy, still a little foggy, but as we work with it more, it's going to become clearer. So just stick with me and get through this section. Just at least read through and up to this portion, don't maybe not start this yet. This is where we're going to pick up on the next video. So hope you're all doing well, and we'll catch you in the next video.